Hello and welcome to Morning Brief Market Sunrise. I'm Ramzan Karmali, live from Yahoo Finance's studios in London. It's Wednesday, 15th October. Coming up on the show, gold breaks $4,200 an ounce for the first time ever as Fed rate cut bets rise. Trump threatens China with a cooking oil embargo over Beijing's refusal to buy US soybeans. And Bank of America delivers stellar profits. So grab your coffee and let's own the morning. Well, the first thing you need to know is that gold prices continue to surge. For the first time ever, it's breached the $4,200 mark. Why? Well, expectations of more US interest rate cuts are on the rise. Plus, broader economic and geopolitical uncertainty also led to investors to buy the safe haven asset. Gold has risen about 60% so far this year, fueled by geopolitical and economic uncertainties, expectations of US rate cuts, strong central bank buying, a broader de-dollarization trend, and robust ETF inflows. All right, the next thing you need to know is that trade tensions between the US and China continue to simmer. President Trump has threatened China with a cooking oil embargo in retaliation for Beijing's refusal to buy US soybeans. The president's latest criticism follows a recent spate of critical remarks he has made about China, raising questions about the status of ongoing trade talks. China has been the top buyer of US soybeans by far, but it has not bought a single American soybean in months amid this ongoing trade spat. Last year, it bought $12.8 billion worth from the US. And the last thing you need to know is investors' expectations for Fed rate cuts is on the rise. It certainly had an impact on markets overnight. US futures are pointing to a positive start to the trading day, and across the globe, it was a similar picture. This all comes off the back of a speech made yesterday by the chairman of the Federal Reserve, Jerome Powell. Well, my colleague Jennifer Schoenberger has the details.
Fed Chair Jay Powell says the outlook for employment and inflation hasn't changed much since the Fed's last policy meeting in September, but that the downside risks to employment have risen and the balance of risks have shifted. Fed officials have penciled in 2 more rate cuts for the remainder of this year, and Powell's comments seem to reinforce that another rate cut is on the table at the next policy meeting slated for October 28th and 29th. Though Powell reiterated that policy is going to be set meeting by meeting and that there is no risk-free course for setting policy, given that the Fed is trying to navigate bringing down inflation while keeping a healthy job market.
I'll stress again that these projections should be understood as representing a range of potential outcomes whose probabilities evolve as new information informs our meeting-by-meeting approach to policymaking. We'll set policy based on the evolution of the economic outlook and the balance of risks rather than following a predetermined path.
Meanwhile, Powell said that the Fed may be getting to the point in the coming months where it can stop shrinking its balance sheet, that is allowing bonds to mature and roll off the Fed's portfolio, thereby decreasing the size of its balance sheet. The Fed's balance sheet currently stands at $6.5 trillion right now. That's nearly 60% bigger than where it stood at the start of 2020. Treasury holdings have been falling off at a rate of $5 billion per month, where mortgage-backed securities have been falling off at a rate of $35 billion per month. If the Fed's balance sheet grew in line with the economy, it would need to shrink by another $800 billion. And as for the dearth of data during this federal government shutdown, Powell says he's taking signal from state unemployment claims as well as ADP's payrolls, but that they are just a supplement to the golden standard of federal government data. He said that if this shutdown persists much longer, then the Fed is not going to be privy to receiving October data, which is going to make things a lot more challenging for the Federal Reserve.
Earnings season rumbles on and banks and financials are taking centre stage once again. Well, yesterday we got some pretty positive results from the likes of Wells Fargo, JP Chase, Citigroup and Goldman Sachs. Their results offered a generally healthy picture of consumer finances and a booming market for deal making and securities trading, Wall Street's bread and butter businesses. Now, the broad concerns over economic and labour growth don't seem to be denting bank earnings so far. JP Chase, the country's largest lender, now expects one of its core credit quality measures to look more favourable this year. Wells Fargo said it has set aside less money to cover customers who might fall behind on loan payments. And Citigroup says a measure of delinquencies has improved from a year earlier. Well, today, Bank of America leads the way, and it looks like it's continuing the trend. Third quarter results beat expectations across the board. Net interest income topped $15.2 billion, and its investment banking arm also performed strongly. Earnings per share came in at $1.06, easily beating the street's call of 94 cents. Revenue came in at $48.22 billion. And as you can see, shares jumping in the pre-market up over 4%. And that's off the back of those earnings release. So impressive stuff there from Bank of America, whose shares up nearly 4.5% in pre-market. Okay, next up with Q3 earnings, the regional banking company, Citizens Financial Group. It reported underlying earnings per share for the third quarter that beat the average analyst estimate too. Earnings per share was expected to come in at $1.03, but came in a bit higher at $1.06 as well. They too had pretty impressive results as well. Shares, as you can see, jumped over 3% in the pre-market. They were actually trading a lot higher initially when the results popped out. So Citizens Financial, another climber in the pre-market. Okay, later this morning, we should also hear from Morgan Stanley. If we get the results in time, we'll update you before the end of the show. Okay, we're going to head for a short break, but when we're back, we'll be looking at the future of fintech because we've got an interview with the Chief Banking Officer of Wise. Welcome back to Market Sunrise. So what does the future of fintech look like? In recent years, global money transfers are some of the areas of banking that have been disrupted by new players. Wise, one of the leading platforms in money transfers, recently hit the headlines in the United States after it announced that it would move its primary listing to New York, although it will keep a listing in London as well. Well, I'm pleased to be joined today by Diana Avila, Chief Banking and Expansion Officer for Wise. Diana, thanks so much for joining us here on Market Sunrise. I'd like to start with a timely question as G20 finance ministers are gathering today. You put out a report spelling out some recommendations for global leaders. What do you think are the most urgent items on their agenda when it comes to global money flows?
Good morning, Ramzan. We believe that the most urgent matters is for policymakers, especially the policymakers within the G20 economies, to make sure that they implement the commitment that has been made in 2020 about improving overall how money moves globally. And we're focusing on two key pillars of this commitment. The first one is making price transparency a reality when consumers are sending money internationally. And secondly, opening up access for non-bank financial institutions to access payment systems so that competition increases, having better results and better outcome for consumers.
Now, from your report, the US scored very poorly on transparency guidance related to international payments. Why do you think that is?
That's correct. The US actually, in our first report, which was published last year, had scored higher. It had scored 4 out of 5. And this year, the score had moved to 3, 4 out of 5. The reason for this is the US rescinded a piece of regulation, a piece of guidelines, that where these guidance were requesting financial institutions to disclose what would be junk fees, to not create false advertisement or expectations around transferring money internationally being free or being at a low cost and not fully disclosing the price and any markup in the FX rate. So this year, this piece of regulation from the CFPB have been withdrawn. meaning that the score is now lower because there's no clear regulation or no clear guideline for financial institutions to fully disclose the price of moving money internationally.
Now, Diana, while Wise is relatively a new player in global financial services, you also work with some big traditional banks in the US and elsewhere. Can you kind of explain your relationship and how are consumers benefiting from these relationships?
Yeah, that's correct. Otherwise, we have been building our strong infrastructure for the past 15 years for moving money internationally. We make it faster. 70% of our international money movement arrives instantly. This is within 20 seconds or less than. And through this infrastructure, we are now enabling banks to also move money internationally for their customers. You're right, we have big names, big banks, traditional banks like Morgan Stanley, Standard Chartered, Itaú in Latin America, Mandiri in Indonesia. Some of these largest banks have integrated to our infrastructure, providing these benefits ultimately to their customers for moving money internationally much faster at a lower price, and also being able to transparently disclose to their customers what is the true cost of moving money internationally.
But some of the traditional banks are also trying to do the same thing as Wise are doing. So what are the pros and cons between working with a traditional bank solely or working with a bank that's integrated Wise's systems or working directly with Wise?
Ultimately, the good thing about this trend and ultimately better regulation around moving money internationally is that the ecosystem improves altogether. So whether it is through the infrastructure that Wise has been creating, whether it is directly providing services to customers or through banks integrating with us or the banks improving themselves, this increases the benefits for the consumers because price transparency becomes a reality, and everyone benefits from being able to move money internationally at a lower cost, knowing exactly how much they are paying, and for it to be faster.
Diana Avila, the Chief Banking and Expansion Officer at Wise, many thanks for your time here on Yahoo Finance.
Thank you so much. My pleasure.
Okay, we're heading now for a quick break, but when we're back, we'll be looking at trending tickers. We'll also be hopefully looking at what Morgan Stanley has to say when their results come out. That's shortly after this break. It's time now for trending tickers. You want to pay attention. The trending stocks we covered yesterday morning ended up being the top gainers of the day. Navitas and Critical Metals. And there's one stock that is accelerating its rally. PZZA, that's Papa John's, is flying in the pre-market on growing speculation about a takeover bid. But there's a lot more going on today. Let's start with two of the largest companies in Europe. Number one, ASML, the Dutch chip giant, is up around 4% in Amsterdam and more than 4% in pre-market on the Nasdaq as well. The stock is propped up by the chip maker's strong earnings report. In short, ASML beat estimates with bookings at 5.4 billion euros, even if orders from China are down. And that's not necessarily a bad thing for investors, given Europe's latest efforts to decouple from Chinese tech in the name of national security. Number two, LVMH. Time for investors to let their champagne corks fly. The French luxury giant surprised many analysts today with a return to growth after many difficult months. Look at the stock, up over 14% in Paris today. Leather goods from Louis Vuitton and other sister brands have been doing better in China, and the big surprise was that even Moet Hennessy, the champagne and spirits division, posted positive results after more than 2 years of struggles. Moving on now to the world of crypto mining. Here's one stock that is, well, simply the most active stock on Yahoo Finance this morning. Bitfarms is up another 10% after closing 10% up yesterday. Oh, now it's up 7% now. Yesterday, the ticker BITF has seen trading volumes soar amid speculation around integrations of blockchain plus AI technologies. But analysts are cautious as the hype could fade as quickly as it started. Now, quick check-in on Stellantis. The automaker is in the green both in Milan and New York. Shares are moving primarily on the announcement of a massive $13 billion investment the largest single investment in the company's 100-year history. Stellantis is investing in production in the United States, specifically at plants in Illinois, Ohio, Michigan, Detroit, and Indiana. Finally, let's take a look at big tech names that are seeing significant trading volumes this morning. Nvidia is leading the pack after closing the day deeply in the red yesterday. Nvidia is up more than 2% in the pre-market at just over $183.60 there. It's being helped by a series of new contracts, including a deal in which Nscale will supply 200,000 Nvidia chips to Microsoft. Nvidia now also has to fend off competition from AMD, which has been getting a lift overnight after it announced a new deal with OpenAI. And speaking of OpenAI, you need to know that the maker of ChatGPT is reported to be on an aggressive fundraising push, chasing new capital and chip deals. That's worth watching because whoever supplies those chips could be the next breakout name. And as you know, there's many earning reports coming from
Oracle is making a big bet on AMD, announcing plans to deploy 50,000 of its AI chips starting next year, potential alternative to NVIDIA's market-dominant GPUs. For more, we're bringing in Yahoo Finance tech editor Dan Howley. Dan.
Yeah, Josh, this is obviously a huge win for AMD. This comes on the heel of their prior deal with OpenAI that saw OpenAI get upwards of 6 gigawatts of GPUs. Now, just to put that into perspective, there was a Reuters report a while back that said about a gigawatt can power about 700,000 homes, 800,000 homes around there. And so you kind of get the idea of how many GPUs that really is. In that deal with OpenAI got about 10%, equivalent to 10%, or has the option to get stocks worth upwards of 10% of AMD. This deal, we're not getting that kind of in-depth detail, but 50,000 GPUs for Oracle. Now, you mentioned NVIDIA. What does this mean for them? It does kind of show that AMD is starting to kind of gain ground, make a little headway as far as NVIDIA goes and the overall AI market. But I don't think NVIDIA has anything to worry about at all at this point. I mean, they have a $300 billion deal with a $100 million deal with OpenAI. They're working with Oracle as well. They work with Microsoft, Google, Meta, XAI. I mean, you name it, they're working with everyone. So I don't think that they have to worry about anything. I don't think they're necessarily, quaking in their boots. But it is something to keep in mind as we continue to see these huge AI investments go on, that AMD is starting to gain a little more traction in this space.
Okay, that was Dan Howley, our tech editor, speaking to Josh Lipton yesterday out on AMD. And as you know, there are many more earnings reports coming from banks this week. Yesterday, we had Stephen Bigard from Argus Research here on Yahoo Finance. He shared some of the key things you need to watch out for.
This was certainly a banner quarter for the banks so far. We're only one day into the earnings cycle, obviously, but the upsides are pretty considerable. Particularly the capital markets. We expected the lending businesses to be, a little bit weak, kind of this low single-digit loan growth, but capital markets really did shine this quarter, and I think that's, part of the justification for the price performance so far is that those rebounding capital markets, and it's really across the board. IPO activity, it's M&A, it's the trading results, fixed income issuance. So there's really no weakness that we're finding, and the conversations from the banks has been constructive as well. So this is a spooling effect generally. Good results tend to portend more good results because whether it's IPO activity, if a company comes out, goes public and does well, it attracts others into it. And we think there's a fair amount of pent-up demand for companies to go public or even take private. We had some of those like Electronic Arts in the quarter. And keep in mind that the deals, even though M&A deal flow topped $1 trillion in the third quarter, banks don't see that revenue right away. It takes a couple of 3 quarters for those deals to close, for the transaction to take place in order for them to get paid for those deals. So that means, looking out a couple of quarters, we would continue to expect that revenues will still be very healthy.
Okay, let's check in on the markets now. We start with Bitcoin, and it's well, it's continuing to struggle. There are reports that the trader who shorted crypto just before last Friday's decline, well, he or she is doubling down. So that's really having an impact on Bitcoin, though it's pretty stable today, but still well below its recent high of 126,000, just trading above 112,000 there, as you can see. Let's check in quickly on gold as well. And just a quick reminder that it has broken past that $4,200 an ounce mark. Demand for the safe haven continues to grow amid not only growing trade tensions, but the fact that the government shutdown also continues to drag on too. Let's turn to Asia, and it's been a very positive trading session here, to be honest. Interestingly, China's consumer prices fell more than expected last month, while the deflation in producer prices persisted. But markets across the board a lot higher, as you can see, in Asia. Let's turn to Europe now, and it's more of the same pretty much. Look at France's CAC 40, though. It's easily outperforming the rest of the market, as you can see there. It's helped by those positive results from LVMH, which in turn supported a strong rally in other luxury stocks like Kering and Hermes. And let's see how Wall Street might open as well too. And I think it's looking, as I said, pretty positive as well. A sea of green. Those rate cut expectations are so far. Positive earnings we've got as well are clearly lifting the mood as well. And we should be getting our Morgan Stanley board up now as well, because results have just come in and looking like another positive beat for the bank as well. Morgan Stanley third quarter net revenues beat estimates $18.22 billion against an expected $16.64 billion by the street. So another big win for the banks. And as you can see, shares in the pre-market on the rise. Okay. Other top lines from Morgan Stanley is that non-interest expenses also were higher than expected, and compensation expenses were higher than expected too. But again, earnings per share came in at $2.80 as well. Don't forget, there's other banking earnings to look out for. We had Bank of America, we showed you earlier as well, another beat as well. Citizens Financial Group, another beat as well. So banking stocks, even yesterday, they generally beat the street estimates. So been a pretty good start to banking to earnings season, especially from our banks in the US. Okay, I think that is all we have time for Market Sunrise for this morning. Stay with Yahoo Finance for continuing live coverage of the markets and your money all day on streaming and online. Coming up next, join Julie Hyman ahead of the market open on Morning Brief. She'll have a lot more analysis on those earnings that we've just broken to you. I'm Ramzan Karmali. Go own the morning.